gold in euros, if you bought gold in British pounds, if you bought gold in New Zealand dollars, Australian dollars, and Canadian dollars, wherever you bought that ounce of gold, you're in the money, right? It's in blue sky territory. Gold priced in the world's reserve currency, though, has yet to break out, and that's the US dollar. So that's what everybody's waiting for.
Today, we are fortunate to be joined by Dave Erfle. He writes a newsletter, The Junior Mining Junkie, also writes a weekly column for Kitco. I think he probably does a lot more. I'll let him tell you about that. But Dave is somebody in the gold and silver mining sector, the precious metal sector, that I've followed for at least the last 10 years. He's someone that always struck me as honest, upfront, respectable. So it's a real honor, and we're fortunate to have you here. Welcome to Ron's Basement, Dave.
Hey, Ron, thanks a lot for that great intro. I appreciate it. Great to be here.
You know, like I said, I've been heavily involved in this sector for a decade, and when I see an interview pop up with your name, I'm always sure to watch it. So on behalf of my viewers, thanks for joining us. If I hopped into an elevator with you later this afternoon, and I guess I'm going to ask you for your elevator pitch. Who is Dave Erfle?
Yeah, well, I came across this sector about 20 years ago. I had a job at UCLA. I was purchasing all the phones and the phone equipment for the university, and I maintained the inventory where it was all maintained. And I kind of had a lot of time on my hands because I streamlined the operation. So I only had to work a few hours a day. You know, it's a state job, so you got all this time in your hands. So I figured I'd try my hand at investing, and I saw all my friends making all this money in tech stocks, and I thought, God, they don't know what they're doing, and they're making all this money. I don't know what I'm doing, so I could make a lot of money in tech stocks too. Well, it was toward the end of the bubble that I decided to do this, and I lost quite a bit of money, and but I came across that forced me to pretty much say, okay, if I'm going to do this investment thing, I better learn what I'm doing. So I came across the mining sector, the gold sector, in 2003, and I came across Richard Russell's Dow Theory Letters, which was a godsend and an education. He sadly passed away in 2015, but he lived in La Jolla, which is close to me, and I struck up kind of a relationship with him, and he taught me so much. And I came across this sector and in 2003, and it just opened my eyes to the monetary system. And so much so, I got into it so much that at the time I was also restoring a house in Pasadena, and I was doing all myself, and I was getting close to the end of finishing it. And there was a huge real estate bubble, as you recall, brewing in 2005. And I had all this equity in my house, and I had this job that I really didn't like. So I did something really crazy. I was alone. I didn't have any children, no responsibilities, really. So I sold the house, and I put all the money, all the money that I profited from my sweat and labor of restoring that house, I put it into juniors. I don't recommend this at home, but it really paid off for me. And my account had tripled in a couple of years, and it pretty much changed my life. And it really got me into this sector even more. And I've been, pretty much a slave to this sector ever since. I moved to Buenos Aires, and I traveled around the world for about 5 years. I didn't have a home for like 5 years. I put all my stuff in storage, and all I did was travel and work on the computer while I was doing it. And then it come around skip forward to April of 2017, and I figured I'd learned enough to start my own newsletter. So that's where I am here today, where I'm pretty much teaching my subscribers how to do what I do, how to make money in this very challenging and very risky sector.
So you are laser focused on the gold and silver market, in particular the junior mining sector within the gold and silver arena. That's safe
Correct.
to say.
Yes.
Okay.
Correct. It's the juniors is where my area of expertise lies, but that's where also where the super high risk is. You know, where there's super high risk, there's super high reward. So you have to manage your risk, and that's basically what I do with my subscribers. I teach them how to manage their risk. It's kind of an over-the-shoulder service where they see how I manage my portfolio, and I teach them how to manage theirs.
Right. So you set yourself up for the opportunity to have some great rewards, but at the same time limit your risk, which is
Right.
important. Right. Yeah.
Avoid the potholes. Exactly.
Yeah.
Yeah.
Well, I
On
want
the
to talk
road to
about
riches.
right. Yeah. Avoid as many as possible anyway. Right.
Exactly. There's been quite a few of them, especially over the past 10 years.
Yeah, and I want to talk about that a little more specifically later in our conversation, because I think, you know, a lot of times what I see, and I'll be curious right now to get your opinion on this,
Mhm.
you see some asymmetric opportunities in the mining sector where the opportunity for something to go up multiple times in value versus the risk of, I mean, you can always lose everything, right? But you know, maybe the risk is, you know, it could go down by 50%, but it could go up 10 times in value. But you can't put all your eggs in one basket because it could go to zero.
Absolutely.
Yeah.
That's a great way to put it. I mean, you have to manage your risk. You have to diversify your risk. You have to remain laser focused on each company and what they're trying to do, and keep in touch with them, establish a relationship, make sure that they're aligned with you as a shareholder. They're putting their hard-earned cash into the company as well. Especially you take a look at their track record. You know, have they done this before? Because this is a very challenging sector. There's so many things that can go wrong with the best project in the world.
Right.
Right. I mean, you could have the best project in the world and you could have it run by a management team that really doesn't know what they're doing, and they could screw it up. And vice versa. You could have a project that seems middle of the road, mediocre, that has a fantastic management team, and they can actually make you money. So it's a very interesting sector, but it's very challenging. That's what drew me to it, the challenge. I love a challenge. You know, I restored a house basically on trial and error. I didn't know what I was doing. I came into this sector not knowing anything about the sector, and I've learned everything from trial and error. You know, I didn't go to college. I didn't go to school to learn any of it. I've learned everything in my life that I've ever tackled. I've done it by trial and error, learning from your mistakes, and you make a lot of them in the sector, and you have to learn from them, because if you don't, you'll be out of it very quickly.
Yeah. Yeah, I heard a saying once that stuck with me and probably will for the rest of my life. No better teacher in life than pain.
Absolutely. Absolutely. You have to lose a lot of money before you make a lot of money in the stock market.
Right.
And I've done that.
Right. Same here. Same here. And sometimes you have to repeat the pain, but then hopefully after the second time, right? It's
Absolutely. Yeah, absolutely. You know, if you come into the stock market and you make a lot of money right out of the gate, that's the worst thing that can happen to you.
Good. That's a great point. Yeah, no, I agree. That's a great point. You
Because
mentioned
you'll end up losing it all later.
right. Been there, done that. Dave is speaking the truth. I can attest from experience.
First Mining Gold is a development company advancing two of the largest gold projects in Canada. Springpole in Ontario and Duparquet, located in Quebec, each already has 5 million ounces of gold reserves, but exploration initiatives are underway at both projects to find even more gold. First Mining is well-financed, has zero debt, and owns an interest in 4 additional Canadian gold development projects.
Yeah, you mentioned alignment when you're looking at these companies, the alignment of management with shareholders. And I have this pet peeve. I do have a degree in accounting, so I understand financial statements, and I would hope numbers pretty well. That I hear people talk about inside ownership, right? And I agree, inside ownership is important. But to me, what's more important, and I'll use an example of a company that I follow real closely, First Mining Gold. Their CEO, I don't know what percentage of the company he owns, maybe it's 1%, less than 1%, but I know from knowing him, like you talked about, you can get to know these guys, right? You can talk to them. I mean, they will talk to you. They're happy to talk to you. I know, and he's publicly stated that whatever a number of shares that he owns, that amount, that's a really material, significant amount of his own personal investable capital. So what I'm saying is sometimes I'll hear with these junior mining companies like, oh, you know, XYZ billionaire owns 30% of the company. And that's great. That's great to hear. But is that 30% that XYZ billionaire owns
lunch money for him?
Yeah, exactly. Right. Yeah, you couldn't have put it better. Right. Whereas you'll say, oh, well, this company only has 2% inside ownership. But yeah, but the CEO maybe has, you know, 40 or 60% of his own personal net worth in the company. He's, to me, more aligned with, I mean, that's on the surface, you got to dig in a little bit.
Absolutely.
Anyway, not to go down that rabbit hole. What do you, let's shift over to the general silver gold markets. We've had a pretty decent run lately with the price of the physical metals. Does it feel different to you this time? I guess it always feels.
You know, it's the gold price has these levels where there's key levels that it consolidates around, it runs to, and then it consolidates around. And then once it builds a strong base around that level, it takes off to the next level. When I came into the sector 20 years ago, that level was $500 an ounce. It took the gold price nearly 15 years to get above $500 an ounce. We had a double bottom at 250 back in 2001, right? But before that, $500 an ounce was the level that it couldn't get above. And it formed a technical pattern below 500, just like it's formed a technical pattern, the same technical pattern at 2000. That's a cup and handle pattern chart, price chart. And technically, a cup and handle pattern is the most explosive pattern, consolidation pattern that in technical analysis. So there was a cup and handle at 500, right? When I sold my house, right, it was about $450 in 2005, and it was bumping up. It was making that handle, bumping up against 500, about to explode. And gold stocks had already made this huge move from 2001 to 2003, and they were consolidating years, about to do the same, to explode. So I was looking at this, and that's one of the reasons I made that decision to do that. Okay. And once it got over $500 an ounce, the gold price, it ran to $1,000 pretty quickly. It ran it to $1,000 by late 2007, early 2008. And we all know what happened in 2007 and 2008. I mean, going into 2008, right? We had the global financial crisis brewing, right? So $1,000 became that next level, right? Where gold, but it only took about a year to consolidate below 1,000 because of what was going on financially. Federal Reserve about to recapitalize the banking system. So with $1,000, it got up to $1,000. It tested it 3 times. And then it finally broke out above 1,000, and then it ran towards 2,000. Well, it got about $75 from 2,000 in 2011, right? But it had made a move from a double bottom in 2001 to nearly $2,000 by 2011. That's a huge move. You know, everybody was celebrating. We had made all this money in the stock market. You know, the HUI Gold Bugs Index went up 1,800%, right? Wow. Gold was going to go to 2,000 and beyond. Everybody was going to be partying forever, right? Well, the bullish boat got way too overcrowded. We needed to consolidate that move. What happened? Gold finally it once it got to 1925, it consolidated around there for a while, and then it broke down. And where did it head towards? $1,000 an ounce, right? For a correction, 50, almost a 50% correction. It hit 1045 in late 2015. Right. I mean, the GDX went down 85%. You know, I mean, these stocks were crushed.
Right.
Right.
So I remember.
Yeah, everybody. Yeah, it was crazy. So here we are, late 2015, building everybody was at when gold was nearing $2,000 an ounce, everybody was saying gold's going over 2,000. Everybody, right? Bullish side of the boat was way overcrowded with everybody saying 2,000. So of course it's not going to happen. So once it got down towards 1,000, everybody was saying gold's going below $1,000. It's inevitable. Gold's going below 1,000. Right? The bearish side of the boat got way overcrowded.
Right.
So make a long story short, basically 1045 was the low, and then the gold price doubled to 2089 in the futures market. It doubled in 4 years. Right. So that move had to consolidate. So that's been consolidating now for the past 3 years, building this handle of a huge cup from 2011 at 1925 to 2020, a higher end of that cup, which is also very bullish on a cup and handle check pattern at 2089. And that handle now has been completed. Right. A 3-year handle has been completed. We had the highest monthly and quarterly close last Friday in gold in history in the futures market. Gold's already broken out. If you bought gold in euros, if you bought gold in British pounds, if you bought gold in New Zealand dollars, Australian dollars, and Canadian dollars, wherever you bought that ounce of gold, you're in the money, right? It's in blue sky territory. Gold priced in the world's reserve currency, though, has yet to break out, and that's the US dollar. So that's what everybody's waiting for. And I've never seen so many bullish catalysts in the 20 years that I've been in this sector. You know, there was always some doubt as to where, okay, it's at this level, it's about to break out. I'm pretty sure it's going to break out, but this or this could happen where it won't break out. Now I'm like, find me a reason where it's not going to break out. Find me a reason why it's not going to break out here. I mean, as the gold price was going over $2,000 on Monday, we had a former president of the United States basically being arrested. And, you know, that's never happened. And he's the front-running candidate for the 2024 election. So basically, the U.S. political situation has reached banana republic phase, right? So people are losing faith in government. They're losing faith in the Federal Reserve, who's made yet another policy error in a long line of policy errors. You know, the global debt is over 300 trillion. You know, they've kicked the can down the road as far as they can kick the can. You know, central bank digital currencies are looming on the horizon. They want these digital currencies to control our lives. And it's already happening in China. They've got these 15-minute cities, and they're very Orwellian, and you can't go anywhere or do anything without the government knowing about it. So, you know, there's so many things on the horizon that tell me that the gold price is about to double again in the next couple of years. And technically, fundamentally, macroeconomically, I mean, all this is coming to a head here. But if you take a look at gold stocks, they're still saying, I don't believe it, especially juniors. Yeah. Herein lies the opportunity. The opportunity is not in gold. Okay, you buy gold for insurance. You buy gold hoping you never have to cash it in. Right, the opportunity lies in juniors. You know, gold stocks have moved up. There's been some FOMO in gold stocks. We're starting to see FOMO in gold. Some in gold stocks, some in royalty and in streamers, but juniors, they're still languishing. I mean, just to give you an idea of how underpriced the juniors are here, when you had the gold price running towards $2,000 an ounce 12 years. We had companies taking out juniors at over $1,000 an ounce in the ground.
Right.
And now you basically, if you take a look at a lot of these juniors that have de-risked these projects with multi-millions of ounces in the ground in safe jurisdictions, raised money at the right time, did all the right things, they're still not being rewarded by the market because the gold price basically has gone sideways for 3 years while inflation has gone crazy. Everything to get it out of the ground, everything to explore for it, to build the mine, to produce it has gone up while the gold price has gone nowhere. So now these juniors are averaging about $40 an ounce in the ground. And the opportunity is sitting there waiting for you to pick these things up off the ground for nothing, but you still have to have a lot of patience, and you still have to buy the right ones, because that's the challenge in this sector. It's littered with garbage.
Yeah.
Right. There's 85 to 90% of these juniors are lifestyle juniors. They're worthless. And it's up to me for my subscribers to pick out the ones that I believe have the 5 to 10 bagger potential, because it could happen so fast in this sector. You know, I mean, that's why you have to accumulate, you know, in times like these, so you can make money later when FOMO comes into the sector, and you can sell these stocks to people who have fear of missing out and are buying at any price.
And they're late to the party.
Right. I mean, I mean,
Right.
that's why it's so important in the sector. You know, you have to buy fishing lines and sell rhino horns, right? I mean, you have to reverse your emotions more than any other sector, I believe, because it can happen so quickly. I'd rather be 6 months too early than a few days too late.
Yeah.
On some of these.
And you know, you as you talk about the juniors now, you know, I have a bit of a financial background, so I'm always looking at the financial statements. Another key component to most of these juniors is they don't have any debt. And so you'll hear people
But they also
say,
have no cash flow.
Right. Right, exactly. No, right. They
consume capital. They don't spit it out.
Yes. But a lot of them will have, I mean, the valuations and it is very tricky, and you know way more about it than I do, but the value proposition by most any metric, historical, financial, anything you compare it to is really, I mean, the value proposition is astounding right now. But it's hard. You know, I think I heard Rick Rule say, you know, like most people, when they go into a grocery store, if tuna fish is on sale for 50% off, they'll buy a couple extra cans of tuna fish because it's such a great deal. But when it comes to these stocks, these mining stocks, you know, they may be 50, 70% off, but it's hard emotionally to get yourself to buy them.
Well, I mean, that's the stock market in a nutshell, basically. You know, I mean, it's the trivial many versus the vital few. You know, you're basically trying to be one of the vital few, taking money from the trivial many. And you know, one of my favorite, you know, Warren Buffett quotes that you can ascribe to the sector is, you know, the stock market is a vehicle that takes away money from the impatient and gives it to the patient. And patience is something you've really had to have over the past 3 years here in this sector. Because basically over the past decade, generalist investors have not been in the sector. They fled in 2013 when the gold price lost $1,550 an ounce. Watching it, I remember a decade ago, I said to myself, 1550. If the gold price goes below 1550, I'm gonna sell out of everything. And I'd already, you know, was winding my portfolio down because, you know, we'd all done so well going into 2011 and 2012. It was still robust. The mining sector was still pretty robust. But as soon as gold price lost 1550, it lost the generalist investor in 2013, and they haven't returned. So basically, as resource investors, we've basically been trading amongst ourselves for the past 10 years. We've had no inclusion of generalist investors. And that's what the mining sector has been trying to do for the past decade, lure them back. What do we have to do to lure them back? Well, you have to shore up your balance sheets, right? I mean, the biggest mistake they made during the last bull market was buy these large bulk tonnage, low margin projects just to get ounces, right? These large ounce projects that were bulk tonnage that needed higher gold prices to be economic, and they did it with dilution, which was a double negative, right? You're buying ounces in the ground that aren't going to be economic until the gold price gets over $2,000. And at the same time, you're doing it with dilution by diluting your shareholders, and it diluted the entire sector. So that scared away the generalists, and they've been trying to lure them back, and they're doing the right things. They've shored up their balance sheets, they pay down their debt. That now they're trying to consolidate within themselves, or they're trying to get bigger and pay dividends to attract investors. And once that takes place, that's when this sector will take off. And I think the $2,000 level is that key level. Once the market begins to price in a $2,000 floor as opposed to 12-year resistance, this is when the generalist investor starts to get involved, because they take a look at, they're looking at things like I was looking at when I got into the sector, right? I came into the sector looking for something that was outperforming while everything else was going down. That's happening again this time, for the first time in almost 20 years, right? Gold is outperforming everything. It's outperforming stocks, it's outperforming bonds, outperforming oil, it's outperforming bank stocks. Well, what isn't outperforming bank stocks? But still, it's outperforming everything. But the miners have yet to really catch hold. I mean, they're still trading. The last time gold was at $2,000 an ounce when Russia rolled into Ukraine, the gold stocks were, I think, 13-14% higher. They still haven't caught up to that level. And I mean, basically gold stocks have been underperforming gold for the past 25, 30 years, believe it or not. And because of the reason why is because, these miners, they made mistakes in the past of buying those ounces, those uneconomic ounces with dilution, really hurt the sector. So the opportunity is there. We just, it's close to really exploding, but we're just not there yet. And but it's getting close. It's getting close.
Yeah.